These presentations will work a comprehensive bookkeeping problem both within Excel as well as within QuickBooks. Excel having the advantages of being able to see all the components and how all those components fit together to make the end product, that end product, the financial statements. QuickBooks having the advantage of being able to use forms, simple data input, and an automated system in order to convert that simple data input into the end product, the financial statements. We will work each component of the problem in Excel first and then work that same information in QuickBooks. Hello, in this presentation we will be entering an adjusting entry related to depreciation into our bookkeeping problem in Excel, keeping in mind how this same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're first going to take a quick look at QuickBooks and then jump over to Excel and enter the data there. When considering depreciation, we're taking a look at the property, plant, and equipment, which QuickBooks will call fixed assets. We could also call it depreciable assets. We're talking about those long-term assets that will be depreciated or go down in value over time, and where we will need some type of estimate in order to decrease those in value. You can see here's our balance sheet, and we have our groupings of current assets, other current assets, and we have our fixed assets. We're talking about the furniture and fixtures. Those are the things that we will be depreciating. Unlike something like supplies or as we looked at prepaid insurance, where we can actually see or calculate exactly how much of that has been decreased, and therefore it makes sense for us to allocate the adjustment directly to the prepaid insurance. Furniture and fixtures, something if we're talking about a couch or something like that, it's not very easy for us later on. We can't say that there's less couchness. It's still the same couch, even if it went down in value. We know if it was something like an automobile, that as soon as we drive it off the lot, that it's supposed to decline in value, even though it's the same automobile. So therefore, we know that this is going to be some type of estimate. And because it's an estimate, we're going to create some other accounts and not be writing down the furniture and fixture or depreciable assets directly, but creating a contra asset account, that contra asset called accumulated depreciation. The expense side also not being called fixed asset expense or furniture and fixture expense, but being called depreciation expense. So that's going to be the journal entry. We'll debit depreciation expense related to, in this case, furniture and fixture, and we will credit accumulated depreciation. We don't see accumulated depreciation yet if we were considering QuickBooks because it's zero, so there's nothing there yet, and therefore the account isn't there. When doing adjusting entries in QuickBooks in just about any system, we typically would use a general journal and put this information into a general journal using debits and credits. However, it is possible to use a register format in order to enter this data into something like QuickBooks. In Excel, as we will do now, we will be using debits and credits to record the adjusting entry. Here we are in Excel. We're going to be using the Adjusting Entries tab here to record our depreciation. The depreciation, like most adjusting entries, will follow the standard rules, and those include the fact that cash will not be affected. We typically have one account on the balance sheet side above the equity accounts and one below on the income statement side, and it's going to have something to do with depreciation in it. So if we go through the accounts and look for something with depreciation, we can see accumulated depreciation up top here. So I'm going to go ahead and highlight this little area yellow to say that's one account we will be dealing with. And if we look at all the accounts on the income statement below the equity section, revenue and expense accounts, that is, we see depreciation expense here. So I'm going to highlight that yellow as well to note that that will be something we will be working with. So even without really understanding, like with most of these adjusting entries, we can find, if we have the trial balance, what the two accounts will be by applying those rules. We're not doing anything to cash. The expenses typically go up, and the other account is going to have a balance sheet account and be something with the name of what we're working with, in this case depreciation in it. We also know which way it's going to go because we know that the income statement accounts, like this account, only go one way. They go up. Expenses go up in the debit direction. So this being a expense account, it's going to go up in the debit direction. So we'll put that on the top of our journal entry. So we're going to copy that in K26, right click and copy. We're going to make our new entry in A22, and like all entries, it's going to be as of the end of the month. 2/28 is the date. We're going to put the depreciation expense up top, right clicking and pasting 123. And then that means that the other side is going to be the credit. Here it is, accumulated depreciation. That's what the credit will then be. We're going to copy the accumulated depreciation, put that on the bottom. We are in B23, right click and paste 123. Then we're going to go and indent. So I'm going to go to the Home tab, Alignment, and increase the indentation, and there we have it. So we can do all that without really understanding what we're doing here. Let's take a quick look once again at what we are doing. We are considering the furniture and fixture that we have purchased, and we're trying to see that it has decreased in value. Rather than writing down the furniture and fixture directly, which would make the most sense, we make another account. It would make sense in that it would tell us exactly what we are doing. It would be easy for us to see exactly what is happening. But in order for us to recognize and tell our reader that this is an estimate, that we don't know how much it exactly went down by, but we do want to recognize the fact that it did go down, we're in essence going to pull the credit half of this account out. This is the debit half. We're going to say we're going to create a credit account, which is really related to directly this account, and show you the decrease that we estimate it to be. And then you'll have to subtract those two out to get the net value. And then we'll record the other side not as furniture and fixture expense, but as depreciation expense on these long-term assets so that you can recognize that it is just an estimate. A couple ways that we can get this estimate. I'm just going to do a quick type of calculation to get the depreciation estimate here, and just to get an idea of what this type of calculation would be. This is a form of straight line calculation. We're going to take the amount, 103,000. Note that we're just going to take the whole thing and depreciate it as if it were just one piece of equipment. In real life, we would have to take each piece of equipment and go through a schedule to depreciate each piece of equipment, and it could be a fairly tedious task, especially if we have different depreciation for tax purposes as well as book purposes and so on and so forth. But the concept all comes down to a straight line method, and then there's variations from that. So we'll just take the 103,000. We're going to subtract the salvage value, which we're going to say is 10,000. That's what we think that we are going to be able to scrap this for at the end of its useful life. So after it's used up, we still think it's going to have worth of 10,000 that we can get. That gives us the depreciable amount, what we expect to decline and depreciate over its useful life. And then we're going to divide that by its useful life, which we're going to say is 10 years. And that'll give us the depreciation per year. So we're going to divide by 10. That gives us the depreciation per year. However, we are only looking at 1 month's worth of depreciation here. So we're going to take that depreciation per year and divide by 12. And that's the 775. Many problems will just give you the 775 when you're looking at the adjusting process, and you'll have to, of course, work through that calculation if looking at the depreciation type problem. We'll do that one more time. It's calculation right here. It's less easy to see when we don't have these sub calculations, but you can get an idea of what it is here. We're going to say equals, and we're going to take once again that 103,000, and we're going to subtract the salvage, which is 10,000, and then we want to divide it by the number of years, which is 10 years. However, if I just divide it now, because of the order of operations, it will do the division of 10,000 divided by 10 rather than 103 minus 10,000 divided by 10. So we need the brackets. If we're just going to write it linearly, I'm going to put the brackets around here and then divide it by 10. And then that would give us the depreciation for a year, and we need to divide that whole thing by 12. I don't need brackets this time. We could put brackets around here and here, but we don't need it because it'll do this bracketed thing first, and then it'll go from division of the 10 and then division of the 12. So we'll just divide by 12, and that'll give us the 775. So that's the amount we're going to use, and we're going to debit that and credit the same amount. So here's our adjusting journal entry we have recorded here, and we're going to post that to our adjusting worksheet in the middle column. So we will post the depreciation first. Here it is there. Here it is here. we will be in the middle column. We are in cell M26. M26. We will select equals and point to that 775, bringing the balance up from 0 to 775. That will also put us out of balance and bring net income down. So we'll select enter. There it is. We're out of balance by that, and net income is brought down by that. Then we're going to record the second piece, accumulated depreciation. Accumulated depreciation is here. We want to be in cell M. We are in M9, selecting equals and pointing to that 775, bringing the balance up from 0 by 775 to 775. And there we have it. That will put us back in balance down here as well. If we see what is going on, then we can say that we are telling our reader now, this is what we bought it for. This is how much we think it went down in value. And if you subtract those two out, the 103 minus the 775, that gives us 102,225. That then is the book value. That's the book value, the estimated value that we believe this is worth. Note that this is our first contra asset account, so it's an asset account with a credit balance, which is contra to the norm of all the asset accounts that have normal debit balances. And so that will be that. And then, of course, the expense, depreciation expense, related to the allocation of the cost of the equipment over the time period which we believe it will be used. And that, of course, will bring down the net income calculation. Hello. In this presentation, we will record an adjusting entry related to depreciation on equipment within QuickBooks Pro 2018. If you've been following along with us, we will be continuing with the Get Great Guitars problem. If not, that's okay. We will be recording adjusting journal entries related to depreciation, discussing what they are, how to record them, and why to record them. If you have the backup file to this point, you could restore that at the File and Restore. We currently have the Open Windows open here to open that View and Open Windows list. We also have the Company Home tab open at Company and Home page. At this point, we will be recording the adjusting entry for depreciation, that being the entry needed in order to decline the value or reduce the value of depreciation. To take a look at that, we're going to look at our reports. So let's go to reports up top. Let's go down to company and financial. We're going to scroll down to the balance sheet first, and we will then select the date range, and I'm going to go up here to customize reports and have the date range of 01/01/21 to 02/28/21, January 1st, 2021 to February 28th, 2021, and OK. So here is our report. We are concentrating on this 103,000 in equipment. If we double click on that, there are a couple items that we have within the equipment section. And what we would need to do here is determine what the life of these equipments are and how are we going to depreciate this equipment over time. In other words, when we buy the equipment, we typically will pay for it or put it on credit or finance it. And then instead of putting it on the books as an expense, we put it on the balance sheet as an asset. And the difference is something that if it's an asset, it's something that's going to help us generate revenue in the future. That's why we have it. We're in essence investing in the equipment to help generate revenue in the future. We haven't yet consumed it. We haven't yet used it in order to help us generate revenue. That's what we hope to do in the future. As we do so, we should write off the cost when we do so. If we close this back out, so that's that 103. If we go to the income statement or the profit and loss, go into reports, go into company and financial, and the profit and loss for 01/01/28 to 02/28 21. Hold on a second. Should go to 01/01/21 to 02/28/21. So January 1st, 2021 to February 28th, 2021 is the period that we are working in. And note that we do not have, of course, that expense here. Now, remember, we paid for 103,000 during the first couple months here in the format of either cash that we paid or financing. And therefore, you would think maybe that we should be putting that 103 on the income statement because we actually bought it. But at this point, if we did that, note what would happen. We'd have a $100,000 loss here. And that's not really accurate because really that equipment is on the books as an asset. If we close the company, we could sell it and still get some value back from it. And that's why we're going to put it on the books as an asset, and then we're going to depreciate it over time. So it is the case that we should have some expense related to those assets, but it should be related to the part of the asset that we actually consumed in order to help us generate this revenue in accordance with the matching principle. So that's what we're going to try to do here. We're going to try to take, going back to the balance sheet, this $103,000 and allocate the amount of use that we got out of it in this time period in order to help generate revenue, thereby matching the expense related to the cost of this asset to these assets to the time period in which they helped us generate revenue and reducing this furniture and fixture account. You would think by doing that we would have an expense called furniture and fixture expense, and we would be just reducing this account directly. But because this is an estimate, then what we're going to do is we're going to create another account called accumulated depreciation, and that'll tell the reader, look, this is what we bought it for, and now we think it went down in value by the accumulated depreciation. So the book value will be the difference on the balance sheet. And then the income statement account that's going to be an expense will not be furniture and equipment expense, rather it will be depreciation expense. So that's what depreciation is in essence. We're going to do a quick calculation that in real life we'd have to take those pieces of equipment and depreciate each of them in a depreciation schedule, often something that is going to be done by an outside CPA firm to help out. It's possibly that we keep the depreciation schedules on different types of schedules depending on how we're going to run the depreciation process, because we could have different depreciation schedules for the books versus the tax code, or we might just want to follow the tax code. That might make it easier. But let's just do a quick calculation to get an idea of what we're doing here. We're going to take this $103,000 and we're going to apply a kind of straight line depreciation. If you are to do that, get some advice on what the useful life is going to be and what the depreciation calculation should be. But this is going to be the concept here. We're going to take the $103,000. We're going to assume that at the end of its useful life, the useful life in our example is going to be 10 years. At the end of 10 years, after we've used up this equipment and consumed it all and it's no longer useful to us, we think that we can still scrap it for the metal or whatever parts within the equipment for $10,000. So we're going to take that $103,000 minus $10,000. And that's going to give us $93,000 that we're going to depreciate over the useful life, which we're estimating to be 10 years. We believe we're going to have this thing for 10 years. It's going to help us generate revenue for 10 years. At the end of that 10-year time, we can still sell it for the scrap. They call it scrap $10,000. And therefore, we have to depreciate $93,000 over that 10-year time period. So the straight line method would just be, would divide that by 10 years. And that would give us $9,300. We're going to depreciate this time just 1 month's worth, however. So if we take that and divide it by 12, we're going to depreciate $775 this month. And so the entry to do that would be a debit to depreciation expense, reducing our net income. And we're going to make a new account, which we're going to credit, which is going to be a contra account, and it's going to be called accumulated depreciation. So let's take a look at that. If we were to do that, normally we would go to the company and we would go to make journal entries and we would debit depreciation expense, increasing the expense, and credit accumulated depreciation. However, we're going to do this without journal entries and we're going to try to do this with just registers. There are only two accounts involved. One is going to be accumulated depreciation, one depreciation expense. We can't go to the expense register because there is not one, and therefore we're going to have to find the accumulated depreciation register. You can't see that one here, that account is here because it currently has nothing in it, but it is in our lists. If we go to lists and we go to chart of accounts and we go to the fixed asset, we have this accumulated depreciation. This account we didn't generate, it was generated by QuickBooks when we set up the company. Just about any company will typically have it if you choose whatever account type you have. In other words, we chose, in this case, the merchandising company when we set up QuickBooks. QuickBooks then gave us a set of accounts, including this account of furniture equipment and the related accumulated depreciation. So what we're going to do is go to the register. And I'm going to do that by going to Banking, Use Register. and then scroll down to that accumulated depreciation register, and then select that item. Here is the register. Nothing's in it at this time. We're going to make our transaction as of 02/28/21, the end of the month that we are working on. Now, these registers are actually more tricky than putting in journal entries if we understand debits and credits. But if we don't understand debits and credits, we can work with these things and use some trial and error to figure this out. There's only 2 accounts to this transaction, so we could try to see which way this thing's going to go. Now, we're looking at this account of accumulated depreciation. It's a contra asset account. You would think it would be increasing, but I think QuickBooks is saying that it's because it's a type of asset, because it's connected to the furniture and fixture, then it's going to be a decrease to the total asset account. So it's actually in the decrease column, and that's something you would have to just use some trial and error, which I have done, in order to know that that's the case. So we're going to record that and see if it does what we want it to do. So I'm going to put in the 775 here, and then we're going to go to the other side of this, which is just going to go to depreciation expense. So if we select the drop down and we go down, we see depreciation expense is going to be down in the expense area. Another account we didn't set up, however, it is an account that typically almost all types of accounts within QuickBooks will set up if we choose to use their setup options. So we're going to put in depreciation expense, type that in here. There it is an expense tab. There will be our journal entry. Only 2 accounts are affected. We are using the register for accumulated depreciation, the other account going to depreciation expense. We're going to record this and see if it does what we hope it to do. What do we hope it to do? We hope that it will decrease total assets, and we hope that the expense will be going up in the expense debit direction, decreasing net income. Let's check it out. So we'll close this out. And it's kind of funny that if we look into the fixed assets section, we got this new account now, accumulated depreciation, now that it has a balance, and it's above the furniture and fixture. Typically, that's not the way it would be. Why is QuickBooks putting it that way? Because both these accounts are in the same account type, and then it's in alphabetical order from there. So in order to kind of fix that, it would be more proper, we'd have to use account numbers in order to fix that, but that's a bit more of a complication. So we're just going to deal with the fact that it's a little reversed here. This is the account that we would have here. We can also make this, by the way, a subsidiary account, and that's another way we could deal with that. But it's okay. We're going to put this is the main account, the 103,000, and this is the depreciation. Therefore, what we are saying here is that we're telling our reader we bought this equipment for 103,000. And we think that it has depreciated for this time period, the first month, of 775, and therefore the book value is 102,225. That's how much we still have current that we're going to use. We're going to consume it through use over the next, in this case, 9 years and 11 months. And if we look at the other side of this, we go to the profit and loss, and we scroll down. We should have depreciation expense. It is an expense, increasing the expenses, and the expenses then will decrease net income. So we're now currently at a loss. We have this other expense of 775 related to the depreciation.